Well, hello everyone, and welcome to our second fund deep dive with our chief strategist, Mike Green. So today's fund in focus will be CDX, which is our high yield ETF. And as for the structure of today's webinar, we will first provide a high level overview of the fund, then change gears a bit and dive deeper into the technicalities and wrap up with a Q&A in the end. So do make sure to submit your questions throughout the presentation using the Q&A function. Also, before we jump into it, please remember that this is not supposed to be investment advice, but hopefully an interesting and informative conversation. So Mike, let's put up some slides and we can bring an overview up.
Fantastic. Yeah, we'll start with our splash screen and then we will we'll move from there. Hopefully everybody can see this. I see it on my screen as we are sharing. We are doing a deep dive into CDX. So CDX is a really interesting product. It's one of my, it's a product that I actually feel quite passionately about in this environment. So the objective with CDX is to create high yield exposures that have a hedged component to it. So we have introduced high yield with a credit hedge. The credit hedge takes multiple forms, but in the simplest form, we want to get the fixed income exposure, the premium associated with high yield, and yet at the same time recognize that credit cycles can represent real risk to the high yield sector. I think this is actually a perfect time to discuss this because we're seeing this somewhat paradoxical divergence between what seems like this incredibly risky event, right? We're headed towards a debt ceiling in the United States. We have huge debates about, is there recession? Is there not a recession that's going on? And yet at the exact same time, we're seeing credit spreads being relatively contained. We're seeing US equities being relatively bid with the NASDAQ making a new year-to-date high. And yet, weirdly enough, if I look at things like the Russell 2000, or if I look at segments of the market that are tied into the credit cycle, they're actually really struggling. They're really in an interesting dichotomy. So when we think about credit hedging, one of the things to remember is they can be super expensive. We all want to get excited about the idea about going out and repeating the idea of the big short and basically creating conditions under which we can be lionized by Steve Carell or even better, Margot Robbie in a Michael Lewis film. But the simple reality is that carrying credit hedges are expensive. And importantly, if I look at something like CDS, all it does is cancel out my exposure to the credit factor, right? So I basically am just lowering myself back to risk-free rates. So we've designed CDX to try to offer protection without incurring that penalty, and walking people through how that is done is the objective of what we're trying to do here. Again, our objective within CDX is to provide income yield with the potential for capital appreciation, particularly if we enter into a rate cutting cycle. And that's going to actually play through in the discussion of what we think is going on right now. So if I look at the holdings of this position, you're going to see that there's this fund. You're going to see that there's a couple of things that are not what you would traditionally expect to see. I've got a dog that's trying to knock my arm out right here. The first is that we hedge this in a couple of different ways. One is that we're using S&P puts. So we'll use out of the money S&P puts, similar to stuff that we do in our other products. Ultimately, if credit is going to blow, you'll see the S&P fall. That creates conditions under which you can protect the portfolio using puts. But the more important one that we're doing is what you see here that's called Morgan S, or the Simplify Custom Quality Equity Index and Custom Junk Equity Index. This is a long short weighting within the fund. You can see that our long position in the quality equities is around 30%. Our short position is around 24%. This is a beta adjusted exposure to what's called the quality junk factor. It's effectively looking at going long companies that don't need to access capital markets, don't need to use credit to finance themselves, and going short companies that are continual and serial refinancings. As a result, it behaves very much like credit spreads. The one other wrinkle that is worth highlighting is that we're achieving most of our exposure through the iShares High Yield Bond Index Total Return Swap. That's actually important because what it means is we're capturing a little bit extra return associated with all the credit funds that are out there that want to short the high yield, use the HYG as their mechanisms of protection. So when people decide to short the HYG, what they're actually doing is paying a premium to do so. We're pulling in that little additional as well. Okay, so why do you want to own bonds, and why do you want to own them compared to something like loans? So this is actually really critical to what's going on right now. The current environment that we're seeing is, whether you want to think that there is a very specific top in the Federal Reserve's hiking cycle, or whether it's kind of 25 to 50 basis points away, doesn't really matter. What we know is it's no longer 500 basis points away, or at least we hope it's not 500 basis points away. That's creating conditions under which you're seeing the market rotate out of loans on the margin and into fixed income bonds, those fixed rate positions that are positioning market participants to benefit from a rate cutting cycle. So when rates are cut, spread products like loans, which are floating rate positions, automatically adjust to lower yields. That means you don't have the potential for the capital appreciation that you might have in the bonds, right? Other pros that exist for bond portfolios is that they're liquid and traded in secondary markets, whereas the loans are typically traded only by appointment. You need access to a loan desk. There's required public filing of financial information under bonds, regardless of whether or not they are they're issued by a publicly traded entity. You're issuing a prospectus that requires you to make regular financial filings. It's easier to pay attention to the underlying quality components of the securities of the company itself. And you can obtain liquid protection in many situations from CDS. Credit default swaps, again, made famous in The Big Short. Cons associated with bonds is that they typically are inferior in capital structure. So loans, bank loans, private loans, et cetera, typically have instituted covenants that give you perfection or seniority in claims in the event of distress, right? Likewise, there is the potential for capital loss if you're wrong and the rate hiking cycle is there. But at this stage of the game, we're actually beginning to see the market participants meaningfully rotate from loans into bonds. And that actually is having some interesting characteristics as well, because loans were so sought after in this rate hiking cycle that we're seeing elements of much lower quality emerge in the loans themselves. Now, that rotation that I was describing that's going from loans into bonds means that the demand for bonds is slightly higher than you would normally expect. At the same time, the very high level of interest rates means that many of the issuers of bonds are doing everything they can to prevent issuing longer dated bonds now. They don't want to raise money at 9+% or 10% in the bond market, because candidly, many of the companies that currently have high yield bonds outstanding and rely on these financing markets can't afford these much higher interest rates, and locking those in would actually meaningfully impair their equity, the management compensation, the returns to their private equity sponsor, et cetera. So we're actually seeing supply being restricted, demand is being increased. That's leading to what I believe is an artificial suppression of credit spreads in the high yield bond space. We can actually see this if we look at the data set, the history of credit risk indices, right, where I'm looking at things like senior loan officer tightening or small business expected credit conditions, consumer sentiment, all do a great job of explaining historical high yield credit spreads. And they're currently telling you we're way off, right? We have much lower credit spreads than you would expect to have. So as a high yield bond investor, you want to seek out some mechanism of protection against this spread widening. You could choose simply not to participate, but then you're missing out on the potential for the much higher returns that could accrue, as well as the potential income or the potential capital appreciation that could happen in the event that the Federal Reserve is forced to cut interest rates in response to the adverse financial conditions that seem to be increasingly expected within the economy, but not reflected within asset prices. Those of you who have listened to my other diatribes talking about the dynamics of passive, many of those things are playing through. But again, this is a really good articulation of where supply is restricted because corporations don't want to issue these bonds, at the same time that demand is enhanced by this rotation from loans into bonds. Now, the way that we approach this in our primary expression is through this quality junk spread. And the reason that this actually becomes really powerful is because quality junk is using the equity component to protect these portfolios. Many of you have heard of the quality factor in equities. One of the characteristics of the quality factor is that these companies don't need to issue. So we're effectively going long companies that are very comfortable and secure in their capital structure and short companies that are continually issuing. That actually creates conditions of the potential for continued appreciation, so a positive income association with the hedge at the same time that you can see the responsiveness of this hedge to spikes in credit events. And this is one of the things I think is so interesting about what happened in 2022 is we saw a momentary spike in credit spreads in 2022, but then it looks radically different than we've seen in prior periods, right? We're just not seeing yet the distress priced into bonds that many people think should actually be there. I mentioned this dynamic that the low quality demand and issuance had declined dramatically. This is actually looking at the issuance into the high yield market. Take a look at this difference. In 2020, $432 billion worth of high yield bonds were issued. In 2021, $457 billion were issued. 2022, that was only 102. Year to date, almost halfway through the year in 2023, we're at $63 billion of total issuance. Again, supply is restricted, demand is marginally higher. That's creating conditions under which many of these bonds that were issued in 2020 and 2021 are beginning to approach their maturity wall. To me, this actually represents an opportunity. We're looking at conditions under which the credit hedge could actually perform spectacularly, even as you're capturing the additional return associated with being invested in lower quality, i.e. non-risk-free assets. That's really it. I think that's a good place to pause and ask questions for the audience.
Yeah, absolutely. So I do have a couple of questions here, Mike, for you. So the first one is quality minus junk a direct hedge?
So it's not. That actually is completely accurate. We are making modifications to try to make it as direct as possible. So we've changed a pure quality metric to reflect industry concentrations that are more similar to the high yield factor as compared to the high yield issuance market as compared to, say, the pure market, right? So we're not trying to just go long the NASDAQ 100, for example, or the leading stocks within the S&P 500. We're actually we're adjusting it by sector to try to have a more consistent universe that reduces the tracking error. Same thing is true within the junk component. If you were to strictly focus on junk, it would lead you to a lot of biotechs, for example. Well, biotechs don't actually issue debt paper, and as a result, they're not actually a great hedge against that credit factor that we're talking about. So again, we're normalizing some of those components. Now, with that said, there will be tracking error associated with that hedge, which is also the reason why we use other tools, one of which we're actually scrambling to get in as quickly as possible, is the use of OTC hedges like CDS themselves. And so we are looking to deploy CDS hedges. I will be very straightforward with that. I think CDS is actually remarkably attractive right now.
Yeah. And another question, how are you sizing and monitoring, maintaining the CDX overlay relative to HYG?
Yeah, so that's a great question. So what we're ultimately trying to do within that hedge is two components. One, we're trying to effectively match the historical beta exposure of high yield relative to that hedge. So we want to try to match the equity beta of high yield to the overlay. The overlay, because it's composed of those quality companies, which you can just in your own mind see have a lower beta than the market in total, right? They're safer, they're less risk, et cetera. They tend to run at a lower beta. They do tend to deliver some alpha, by the way. So that component, we're running at about 1/3 or about 30% exposure to the market. Again, that's consistent with the historical beta of high yield itself. The shorts, as I mentioned, are slightly smaller, and that's because those shorts do actually carry a higher beta. You can just simply think about it as they're riskier companies. Less of their total asset value is encapsulated within equities. They don't often have significant net cash on the balance sheet. They tend to run very levered. And so the beta of the junk index tends to run about 1.5. So when we're running those two against each other, we're reducing the junk short versus the quality long to try to keep that relatively matched. The overall weight at 0.3 is designed to reduce a significant fraction of the beta exposure of the high yield. But again, there will be tracking error associated with this. And it's, again, one of the reasons why we actually are deploying additional hedges in the form of the S&P puts itself, as well as dynamics like CDS directly. Which we, just be clear on CDS, I just want to emphasize, in general, we would not try to carry a long-term exposure to CDS because, again, going back to the early observations, it's remarkably expensive to hedge.
Thanks. And then we have, do you believe that the quality minus junk overlay to be positively convex or just a linear negative beta to risk?
So we actually do think that it is positively convex, but I want to caution people that, like all shorts, right, eventually they become a smaller portion of your portfolio. So a really good example of that has been the contribution on a year-to-date basis from this hedge. We actually started the year with a relatively robust hedge against junk. In this last month, we've actually had to refresh that because the shorts get smaller and smaller and smaller, right? As they become, it works the opposite in many ways of CDS. Now, the flip side of that, of course, is that as the credit portion of high yield widens, as the coupons become larger, effectively the index becomes less risky because you're receiving more current income relative to the capital that you've deployed. So I'm actually quite comfortable with that hedge exposure. Again, if I were to go back, let me share the screen again quickly just to show people this. We do experience the same type of convexity. I'm sorry, that's the wrong chart. We do experience the same type of convexity that you see within CDS, but it's not quite, or within spreads, but it's not quite as convex. And that's one of the reasons why I'm actually really attracted to CDS at this point. I think it's really important for people to be thinking about how artificially compressed spreads are in high yield right now by this dynamic of reduced supply, increased issuance.
Thank you. And then we have another one. So the prior slide showed OAS spreads versus historical norms. Is high yield worth the risk now at this level, especially considering the more attractive short-term UST rates?
I think that's a great question. The quick answer is yes. I actually do think that there's the opportunity for better than expected results coming out of high yield. But I think that's particularly true if you're hedging, right? Again, I think that there are some really unique opportunities that exist right now within this space, particularly in things like the deployment of CDS. I'm internally, people at Simplify can tell you that I'm very much champing at the bit on these issues. And the great irony, of course, is that under current market conditions, as we approach the debt ceiling, ironically, I actually think the debt ceiling resolution and the liquidity drain that is created by the refilling of the TGA represents an extraordinary opportunity for investors that are positioned to take advantage of that risk off, that potential risk off event.
And this is a question that we actually get a lot, speaking to clients and investors. How should we think about counterparty risk since these underlying exposures are taken via derivatives?
No, it's a great question. So there are two different types of derivative exposures. There's those that you're actually sourcing effectively where you need to have somebody else pay you for it, and those that you have a exchange on, right? So again, S&P puts are exchange traded. I don't see any issue with counterparty risk there. That's one of the reasons why we use multiple forms of hedging. Just candidly, if counterparty risk actually becomes a meaningful component, I'm going to guess the S&P is quite a bit lower. But that is actually a legitimate concern when you think about events like the global financial crisis. We work very hard to make sure that the counterparties that we're working with are well positioned to be protected in those environments. And we don't really see the same behavior that we saw in the global financial crisis, where the exposures in the investment banking world are really the core exposure. I'm actually not that worried about counterparty risk in that context. I'm much more worried about a credit default cycle tied to the candidly over-levered corporate space.
And how much of the yield from the high yield bonds are eaten up by the cost of hedging?
So that is exactly why we deployed this type of hedge as on a standardized basis as compared to a CDS, right? So we actually expect, and this has been our experience since launch, that our credit hedge is going to be a net positive contributor. The frustration that you hear from many people about the NASDAQ outperforming or the large quality stocks outperforming relative to the quote unquote cheap cyclicals is actually a manifestation of this dynamic. We're watching this cheap cyclicals, those companies that need to tap capital markets that often are reflected in things like the Russell 2000 value or the Russell 2000, the Russell microcap value, which is a very good proxy for this sort of behavior. We're seeing those sit at lows in the year, right? So while the market has shown headline performance that looked quite positive, we're just not seeing that in the majority of companies. The majority of stocks in the Russell 2000 are now down for the year, even as the NASDAQ is up 20+%.
Another question here. What are your expectations for potential performance relative to buy and hold high yield? Same return, lower volatility, and drawdowns, higher return, same risk, etc.
Yeah, so what we're really trying to achieve is twofold. One is we think that we can actually run a high yield exposure that carries less volatility and has significantly lower drawdowns. I'd encourage you to talk to Simplify, to your Simplify sales team. We have run back tests of this. You can actually obviously guess that any back test that would be shown is going to say, hey, it's a great strategy, right? There is no back test that's put forward that says anything else. But we actually expect that this will outperform over a full credit cycle. Ironically, when we launched this, it was into a bit of a jumped cycle, right? We actually saw pressure on many of the large quality names in the early implementation of this, in the early days of this product. What we love is how well it's responded in this last cycle. It's one of the reasons that we emphasize that we're actually increasingly comfortable highlighting this opportunity for investors. We really feel very strongly that the opportunities for properly hedged credit exposure to outperform is significant.
Thanks. Those were the questions that we had, but maybe Mike, just to wrap this up, like what should investors think about timing for CDX? Like when is a good time to sort of, invest in this kind of a strategy?
Well, so I'm going to lay it out there very straight in a very straightforward fashion, right? If you're investing in protection after the event has occurred, you typically should expect that you're going to underperform. And I would suggest that that is by and large been the cycle from the COVID highs, right? We saw a brief outperformance of quality factors in the immediate aftermath of the COVID cycle. As we look at where we are today, I think the thing that I find most interesting is that despite fears of a recession, despite the indications that credit spreads should be significantly wider on things like senior loan officer surveys, the stress we're seeing in the banking system, the lack of issuance, which tells you that companies themselves are much more concerned at issuing at these levels of interest rates, we're just not seeing that properly priced in the market. And so I really actually think that the opportunity is set if you're going to try to capture the higher yields and the potential for capital appreciation that exists in the event that the Fed is forced to cut interest rates or begins to cut interest rates if the inflation battle is largely over, which is certainly what I'm seeing, then you want to actually approach this from the standpoint of taking advantage of that disconnect. To me, this is one of the real opportunities that exists as we look at 2023 is for that spread widening to play into outperformance by this type of product.
Great, thank you. And any final words before we wrap this up?
No, just, I mean, look, I really appreciate people showing up and watching these deep dives. It's, a real privilege to be able to share our thinking and how we choose to approach these problems with our listening audience. And for those who choose to invest, we look forward to having you join us in this process.
Yeah, I agree. Well, Mike, thanks so much for coming along and doing this. And thanks for all the people that tuned in, and make sure that you sign up for the next deep dive.